What if I told you that the biggest mistake you're making in trading isn't about picking the wrong stocks, but about starting with positions that are far too large? It sounds counterintuitive, doesn't it? After all, we've been conditioned to believe that big wins require big bets, that fortune favors the bold, and that playing small is the same as playing scared. But here's the truth that separates traders who build lasting wealth from those who blow up their accounts. Every massive fortune in trading history began with positions so small they would embarrass most beginners. Think about it for a moment. Has this ever happened to you? You analyze a chart, you're absolutely convinced you've found the perfect setup, and you go all in with a position size that makes your palms sweat. Then the market does what markets do best. It moves against you, and suddenly you're not analyzing price action anymore. You're managing panic. That single decision, that moment of oversizing, transforms you from a calculated trader into an emotional reactor. And that's exactly where most trading careers end before they ever really begin. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Now, here's what most traders never understand about position sizing. Small trades aren't just a safety mechanism, they're actually your most sophisticated market intelligence tool. When you enter with a tiny position, something remarkable happens. You're no longer trying to force the market to validate your ego or rescue your account. Instead, you become an observer, a student of actual price behavior, rather than a prisoner of your own predictions. That small stake gives you permission to be wrong without being destroyed. And, more importantly, it teaches you to read what the market is actually saying instead of what you hope it's saying. What you're about to discover might surprise you, because the conventional wisdom about trading has it completely backwards. We're taught to study harder, analyze deeper, find better setups, and yes, those things matter. But none of that preparation means anything if you haven't learned the fundamental skill of starting small and letting the market prove you right before you commit serious capital. Every legendary trader understood this principle, yet it remains the most violated rule in trading. Stay with me until the end, because we're going to explore exactly how these tiny positions become your translator for market language. How they expose your emotional weaknesses before they cost you real money, and most critically, how to systematically scale these small beginnings into positions that capture genuine trends. The pathway from pocket change to substantial profits isn't about courage or conviction. It's about understanding that the market rewards alignment, not aggression, and that alignment can only be discovered through careful incremental testing. So let's dive into why starting small isn't just smart risk management, but actually the secret weapon that transforms amateur speculation into professional trading. The transformation that happens when you're forced to trade with limited capital is profound, and I don't think enough people talk about this hidden truth. See, when you can't afford to be reckless, when every single trade matters because your account is small, something shifts in your psychology. You develop what I call the 3 pillars of sustainable trading: discipline, patience, and the wisdom to wait for the market to actually show its hand before you act. These aren't abstract concepts you read about in books. They're real skills forged through the experience of trading with constraints that don't allow you the luxury of emotional decisions. Most people see small positions as a limitation, something to graduate from as quickly as possible. But here's the impact that most traders miss entirely. Those constraints are actually your greatest teacher. When you're working with limited stakes, you can't afford to chase every shiny setup that appears on your screen. You can't jump into trades just because you're bored or because everyone on social media is talking about a particular stock. Instead, you're forced to become selective, methodical, intentional. Every entry has to earn its place in your portfolio, and that mindset is worth more than any technical indicator you'll ever learn. Now I want to go even deeper into this, because the real killer in trading isn't bad analysis or poor chart reading. It's the fear of missing out that makes otherwise intelligent people do incredibly stupid things. This is where the journey from struggling trader to consistently profitable one gets decided. You see a stock starting to move, your analysis says it looks good, and immediately that voice in your head starts screaming at you, "Get in now. If you wait, you'll miss it. Everyone else is already making money while you're sitting here overthinking." That urgency, that panic, that feeling that the opportunity is slipping through your fingers, it's a trap. It's the market's way of testing whether you're trading with discipline or desperation. If this resonated with you, hit that subscribe button. You'll get more content focused on what actually works in real trading, not just theory. The phrase turning small positions into fortunes gets thrown around a lot, but people completely misunderstand what it means. They imagine some magical moment where a tiny bet suddenly explodes into life-changing money overnight. That's not reality. That's lottery thinking disguised as trading strategy. The actual path is far less dramatic but infinitely more reliable. You start small, you wait for the market to confirm your thesis through actual price movement, and only then, only when the evidence is undeniable, do you gradually add to your position. This systematic growth isn't exciting, it doesn't make for great social media stories, but it's how real wealth gets built in the markets. Behind the scenes of every successful trading career, there's this fundamental decision point that determines everything that follows. Will you let patience guide your entries, or will you let fear of missing out dictate your actions? Most traders never make it past this crossroads because they can't tolerate the discomfort of watching a stock move without them. They convince themselves that waiting for confirmation means missing the opportunity, when in reality, waiting for confirmation is what separates controlled risk from gambling. Write in the comments, small and patient, if this approach resonates with how you want to trade. Here's what shifts the entire game when you understand this principle. A small position is never just about the money at risk. It's reconnaissance. It's intelligence gathering. Think of it like sending a scout ahead into unfamiliar territory before you march your entire army through. That small trade is your eyes and ears, reporting back about what the market actually looks like on the ground level, not from the theoretical safety of your analysis screen. The hidden truth that separates professionals from amateurs is this: the pros never commit fully until they've tested the waters, until they've seen how the market responds to their initial probe. This reconnaissance mindset completely changes your relationship with risk. You're not gambling, you're investigating. You're not predicting, you're observing. And here's the revelation that most traders never grasp. The market will always tell you what it's planning to do, but only if you're positioned small enough to actually listen without panic clouding your judgment. When you go in heavy right from the start, every tick against you feels like a personal attack. Every moment of hesitation in the stock feels like impending doom. But when your position is small, you can actually watch the price action with clarity, reading the subtle signals that reveal whether you're aligned with genuine momentum or fighting against the current. Now I want to show you something that changes everything once you see it. Winning trades and losing trades have completely different personalities, completely different behavior patterns. A winning trade doesn't stutter, it doesn't second-guess itself. It moves with a kind of confidence that's unmistakable once you learn to recognize it. When you enter small and the market agrees with you, that stock pushes forward with conviction, holds support cleanly, and doesn't waste time dragging its feet through indecision. That behavior is the market speaking to you in the clearest language it knows: validation. Losing trades, on the other hand, reveal themselves just as clearly if you're paying attention. They hesitate, they drift, they move sideways when they should be moving up. They break support when they should be holding it. And here's where the transformation in your trading happens. When you start small, you can afford to read these signals objectively. You can see a losing trade for what it is and exit quickly without the emotional baggage of having bet your entire account on being right. The journey from inconsistent to consistent trading happens at this exact intersection, when you learn to add only to trades that are proving themselves through price action, never to trades that are making you hope and pray. This is the mindset shift that separates scaling up from averaging down. One builds wealth, the other destroys it. When the market proves you right through clean, decisive movement, that's your signal to carefully add more. When the market proves you wrong through weak, uncertain behavior, that's your signal to get out, not dig deeper. The impact of following this single principle cannot be overstated. It's the difference between controlled growth and catastrophic losses. Drop a comment saying, "I'm reading the signals," if you're starting to see the difference between trading with hope versus trading with evidence. The most painful pattern I see repeated endlessly in trading is this: traders pour more money into positions that are bleeding while refusing to add to the ones that are working. It's completely backwards, yet almost everyone does it at some point in their journey. And here's what makes this so revealing. When you trade with small positions, this destructive behavior becomes impossible to hide from yourself. Those small stakes act like a mirror reflecting your true decision-making process, showing you whether you're responding to what the market is actually doing or simply reacting to your own emotional discomfort. Think about the psychology behind this for a moment. When a trade goes against you, there's this overwhelming urge to fix it, to average down, to prove that your original analysis was correct. Your ego gets involved, your need to be right takes over, and suddenly you're no longer trading the market, you're trading your emotions. But when a trade is working, when it's moving in your favor, fear creeps in from a different angle. You become afraid of losing those gains, afraid of looking greedy, afraid that if you add more, the market will immediately reverse and punish you for your confidence. So you do nothing, or worse, you take profits too early while simultaneously holding on to your losers, hoping they'll turn around. This is where the transformation from struggling trader to profitable trader really crystallizes. Small positions force you to confront these patterns before they destroy your account. When you're working with limited capital, you simply cannot afford to keep feeding losing trades. The math won't allow it. And that constraint, that limitation, becomes your greatest teacher, because it shows you in real time whether you're driven by discipline or by the desperate need to be proven right. The hidden truth is that most trading failures aren't about bad strategies or poor market knowledge. They're about traders who can't protect themselves from their own worst impulses. Now let me show you why protection and growth are two sides of the same coin, not opposing forces. If you can't keep your losses small, if you can't exit trades that aren't working, then you'll never have the capital or the psychological stability to let winning trades grow into something meaningful. This is the foundation that everything else builds on. Starting correctly matters infinitely more than starting big, because a correct start means you're aligned with actual market behavior rather than fighting against it. Your small position becomes a conversation with the market. You propose an idea through your entry, and the market responds through price action. When that response is positive, when the market shows you through its behavior that you're on the right side, that's when measured scaling makes sense. But here's the critical piece most people miss. You only increase size at the pace the market invites, never faster. The market will tell you through volume, through how it holds support, through how it breaks resistance, whether it wants you to add more. That invitation has to be clear, unmistakable, proven through actual movement. This approach protects you from overcommitting to ideas that sound good in theory but fall apart in practice, while simultaneously positioning you to capture genuine trends when they develop. Type protection first in the comments if you're understanding how defense creates offense in trading. The difference between traders who last and traders who disappear comes down to one fundamental decision. Will you trade based on evidence or based on what you hope will happen? This sounds simple, almost obvious, but the impact of this distinction reaches into every single trade you'll ever make. Evidence-based trading means you're watching what the price is actually doing right now, in this moment, on your screen. It means you're reading volume, observing how the stock reacts at key levels, noticing whether buyers are stepping in with conviction or whether the move is weak and unconvincing. There's no mysticism here, no gut feelings, no trading on vibes, just pure observation followed by disciplined execution. But here's where most people get tripped up on this journey. They confuse their analysis with evidence. They do their homework. They study the chart. They build a thesis about where the stock should go, and then they treat that thesis as if it's already proven. That's prediction, not observation. That's hope dressed up as strategy. The transformation happens when you realize that your analysis is just a hypothesis until the market confirms it through actual price movement. Your small position is the experiment that tests whether your hypothesis matches reality, and the evidence either supports adding more or suggests getting out. Now, let me reveal something about the traders who don't make it, the ones who blow up their accounts and disappear from the markets within their first year. Almost universally, they share this fatal flaw. They try to impose their will on the market. They decide when a stock should move, how fast it should move, where it should go, and they get increasingly frustrated when reality doesn't cooperate with their timeline. They're trying to force the market to dance to their music instead of learning to move with the rhythm the market is already playing. This is ego trading, and the market has no mercy for egos. If this delivered value, hit the like button. It helps this reach other traders who need to hear it. When you embrace starting small, something profound shifts in your mindset. You're no longer in a position where you need to force anything. You can afford to listen, to observe, to let the stock reveal its true character without the pressure of needing it to behave a certain way. The market tells its own story through every candle, every volume bar, every test of support and resistance. That story is always honest, always transparent, but only to traders who have positioned themselves to hear it without their own desperation drowning out the signal. Behind the scenes of every successful trade is this patience, this willingness to let price action guide the decisions rather than trying to bend the market to fit your predetermined narrative. The stock will show you whether it wants to go higher through how it behaves during pullbacks, whether it's finding support, whether buyers are defending key levels. And equally important, it will show you when the idea isn't working through sluggish movement, failed breakouts, or inability to hold gains. Both messages are valuable, but only if you're positioned small enough to receive them clearly. Comment evidence over ego if you're committed to letting the market lead instead of trying to force your will on it. There's something almost magical about watching a properly managed small position grow, but the magic isn't in luck or timing. It's in the compounding effect of aligned decisions. Picture a snowball at the top of a hill. At first it's tiny, almost insignificant, but as it rolls downhill and conditions are right, it gathers mass naturally, effortlessly, not because someone is pushing it harder, but because momentum itself does the work. That's exactly how professional traders build positions. They don't force growth through aggressive sizing or wishful thinking. They let the market provide the momentum, and they simply add to what's already working, layer by layer, as the trend proves it has legs. This is the hidden truth about how real wealth gets built in trading. It's not dramatic. It's not a single heroic bet that pays off spectacularly. It's the systematic accumulation of an edge, repeated over and over, with the discipline to add only when the market invites you, and the wisdom to protect your capital like a farmer protects seeds. You don't plant everything at once and hope for rain. You test the soil, you watch the weather patterns, you plant carefully where conditions are most favorable, and you protect what you've planted from threats. This mindset shift from gambler to cultivator changes everything about how you approach each trade. Now let me tell you something that might sting a bit, but needs to be said. Your confidence means absolutely nothing to the market. I don't care how many hours you spent analyzing that chart, how convinced you are about the setup, how certain you feel about the direction. The market doesn't care. It never has. It never will. The market responds only to buying and selling pressure, to supply and demand dynamics, to price and volume. Your beliefs, your conviction, your carefully constructed thesis, none of that moves the needle even a fraction of a tick. This revelation is humbling, but it's also liberating once you fully internalize it. Small positions become your barometer precisely because they let you test whether your confidence is justified by reality or whether it's just confidence. They act as a safety valve, allowing you to feel the temperature of the market without getting burned when you're wrong. And you will be wrong repeatedly, no matter how good you get. The question isn't whether you'll face losing trades. It's whether those losses stay small and manageable, or whether they devastate your account because you sized up based on confidence rather than evidence. Your entire job as a trader is to align yourself with what the market is actually doing, not to convince the market to align with what you think it should do. This distinction is everything. When you start small, you create the space to observe without the crushing pressure of needing to be right. Immediately, you can watch how the stock behaves at support, whether buyers show up with conviction, whether the volume profile supports the move. These observations tell you whether to build the position or cut it, and that decision comes from market behavior, not from how strongly you believe in your analysis. The impact of this approach compounds over time because you're consistently reinforcing good trades and quickly abandoning bad ones. Behind the scenes, this is how traders survive long. Enough to thrive, they protect their capital religiously while letting winning positions breathe and grow at their own natural pace. Write alignment over conviction in the comments if this perspective is shifting how you think about position sizing. Here's where we get to one of the most powerful principles in all of trading, and it's deceptively simple. Only scale after the market confirms your idea through actual price movement. This isn't about waiting for perfection or trying to catch the absolute bottom. It's about letting the market show you, through its behavior, that your thesis has merit before you commit serious capital. Confirmation means the stock is doing what it should do if you're right. It's breaking through resistance cleanly. It's holding support with conviction. It's showing you through volume and price action that buyers are in control. If the market can't back up your opinion with actual movement, then your opinion simply isn't worth anything on the trading floor, no matter how brilliant the analysis seemed on paper. This is the discipline that separates traders who build sustainable careers from those who experience brief success, followed by devastating losses. The temptation is always there to anticipate, to get in early, to try to catch the move before it happens, but that's gambling on your ability to predict the future, and the future is unknowable. What you can know is what's happening right now, what the price is actually doing in this moment. When you scale only after confirmation, you're building positions on evidence rather than hope, and that foundation is unshakable because it's rooted in reality. Now, I want to reveal something about small positions that most traders never consider. These tiny stakes you place aren't just testing the market, they're testing you. They act like a psychological mirror, reflecting back your true emotional state with brutal honesty. When you have a small position on and it moves against you by a few ticks, do you immediately feel anxious? Does your heart rate increase? Do you start checking the chart obsessively? Or when it moves in your favor, do you get excited too quickly? Start imagining what the profit could be if only this were a bigger position. Feel the urge to add more before confirmation appears. These reactions tell you everything about whether you're ready for larger size. The hidden truth is this: whatever emotions surface with small stakes get amplified exponentially when real money is on the line. If you can't remain calm and objective with $100 at risk, you absolutely will not maintain composure with 10,000 at risk. The anxiety doesn't scale linearly, it compounds. This is why small positions are such essential tests of your psychological readiness. They show you whether you're trading from a place of discipline and patience or from a place of fear and impulsivity. And here's the revelation that changes everything. Most traders skip this step entirely. They jump straight to meaningful size without ever examining their emotional responses under pressure. And then they wonder why they make irrational decisions when the stakes increase. The journey to consistent profitability requires this level of self-awareness. You have to understand your own patterns, your own triggers, your own weaknesses. Small positions give you a safe laboratory to study yourself without catastrophic consequences. They reveal whether you follow your rules or break them, whether you trust your process or second-guess every decision, whether you can sit patiently or need constant action. Behind the scenes of every disciplined trader is someone who did this internal work, who used small stakes to build emotional resilience before ever scaling up. Drop mirror test in the comments if you're recognizing patterns in your own trading behavior through this lens. The most liberating mindset shift you can make as a trader is realizing that you don't owe the market anything. You don't have to commit your capital just because you did your homework, just because the setup looks good, just because the analysis is compelling. The market has to earn your money by proving through actual price action that your thesis is valid. This completely inverts the power dynamic that most traders operate under. They act as if they're fortunate to participate in the market, as if they should be grateful for the opportunity to risk their capital. But the truth is, your capital is valuable, it's limited, and the market needs to demonstrate that it deserves your commitment before you hand it over. Think about how this changes your entire approach. Instead of rushing to get positioned because you're afraid of missing the move, you become selective, almost skeptical. You place that small initial position, and then you watch. You're not hoping, you're observing. The stock needs to show you strength, real strength, not just a bounce or a temporary wiggle. It needs to break through resistance with volume, hold gains during pullbacks, demonstrate that buyers are genuinely in control. Only after these behaviors emerge does it make sense to add more. This approach keeps you safe from the most dangerous trap in trading, rushing into unproven setups with size that exceeds what the evidence supports. Now, let me show you the fundamental difference between traders who compound their accounts over time and traders who experience violent swings between big wins and devastating losses. It all comes down to alignment versus aggression. Aggressive traders believe that big profits require big bets, that you have to swing hard to hit home runs, that timidity is the enemy of success. But here's the hidden truth they miss. The biggest, most sustainable profits don't come from forcing your will on the market. They come from moving in perfect harmony with what the market is already doing. A small position that grows naturally because the market keeps inviting you. To add more will always outperform a large position that you've shoved into a setup before it's proven itself. The difference in psychological pressure alone is massive. When you're aligned with the market, adding to your position feels calm, logical, almost inevitable. When you're fighting the market with oversized positions, every moment is stress, every tick against you feels threatening. Every decision comes from a place of emotional survival rather than strategic thinking. The market rewards those who learn to dance with it rather than wrestle against it. Behind the scenes of every great trader is someone who figured out that their job isn't to predict where the market will go, but to recognize when the market is moving with momentum and to participate in that movement with measured, intelligent position building. They scale only when the trend proves it's continuing through higher highs, through strong volume, through clean price structure. They're not guessing about what comes next. They're responding to what's happening now. This journey from aggressive sizing to aligned scaling represents a complete transformation in how you think about trading. It's the difference between treating each trade as a battle you must win and treating each trade as a conversation where the market tells you whether to proceed or retreat. The impact of this shift cannot be overstated because it affects every single decision you make, every entry, every exit, every moment of doubt or conviction. Type aligned, not aggressive, if this framework is reshaping how you approach position building. If you're still here with me, you've just absorbed something that most traders never fully grasp in their entire careers. This isn't surface-level advice about which indicators to use or what patterns to chase. This is the foundational mindset that separates sustainable success from temporary luck. And the fact that you stayed through this entire conversation tells me you're serious about transforming the way you approach the markets. Look, I put these videos together because I genuinely believe this information changes lives when it's applied correctly. If this resonated with you, if you found value in this perspective, hit that subscribe button. Not because I need the numbers, but because you deserve to keep getting content that actually moves the needle in your trading journey. Every video on this channel is built with the same intention, to give you frameworks that work in real market conditions, not theory that sounds good, but falls apart when you risk actual capital. And do me a favor, leave a comment saying, "I made it to the end, so I know you were here for the full message." It helps me understand what's connecting with traders like you, and honestly, it's encouraging to see who's putting in the work to truly understand these principles rather than just looking for quick tips. If this video earned it, go ahead and hit that like button. It's a small gesture, but it helps this content reach other traders who need to hear it. People who are tired of the conventional wisdom that doesn't actually produce results. Now, there's a video right here that takes this further. It complements everything we just covered and dives into how to actually manage these positions once they're working. Click and continue with me over there, because the next piece of this puzzle is waiting for you.